Yeah, thank you very much for joining us today. I'm Sebastian Spio-Garbrah, the chairman of the Canada Africa Chamber of Business. And thank you so much for joining us. We'll be talking today about investor relations post the whole COVID pandemic. Clearly, in the last few years, the way and manner in which investors relate to companies and that whole ecosystem was much more brick and mortar. You had to, draw up your plans, go in with your pitch deck, and sort of talk to investors. And capitalism must go on despite the lockdown. And I think this conversation is just to sort of rub minds as to how the move to a more digital world. I mean, in a certain sense, this pandemic has accelerated the digitization of every platform. And I think this will be a very interesting conversation to sort of rub minds and figure out how that digitization, the rapid acceleration of digitization and investor relations could affect both companies who are looking to raise money and investors looking to place money. So I'll turn over to Bianca from Sixth, which is, as you well know, for some of you, an amazing platform which has been really at the forefront of this epoch. I mean, in some senses, Sixth saw this coming a few years ago and have built a platform to dramatically scale up the digitization of investor relations. And then there's Millie from Deloitte who will be giving us more wisdom. So maybe I turn to Bianca. Thank you.
Thank you. Thank you so much. I appreciate it. So in my presentation today, I'm going to be talking to you a little bit about Africa in a post-COVID-19 world. But to start us off, I want to talk about the big shift that's occurred. So for a very long time, investments in Africa were made by the people who've actually physically gone there, the people who've actually seen the opportunity with their own eyes. And as a result, this has limited the number of people who actually understand the opportunity for Africa. And now in our post-COVID-19 world, investors are further unable to travel to Africa to gain that understanding. COVID-19 has also created historic levels of uncertainty, and from an economic perspective, the fallout from zeroed interest rates, trillions of dollars of money being printed, and massive stimulus spending will be with us for years to come. Markets are in chaos and the rules of the game are changing, but out of crisis comes opportunity. As investors reevaluate their investment thesis, there is an opportunity for African businesses to come out ahead. So in the old world, investors were forced to rely on broker-dealers, on financial advisors to execute trades for them. They paid high transaction fees, they used expensive terminals, and the process was exceedingly slow. Global opportunities in Africa and beyond were not recommended by your broker because they didn't have a relationship with those teams. Companies never made it into their Rolodex. However, investors today are more self-directed than ever before. They do their own research, they leverage the advice of others in their decision-making, and they can make a decision to participate in any company at any time, anywhere. With a click of a button from mobile, tablet, or desktop, investors can choose to embrace a company's future or to abandon it. This shift in investor behavior is significant because there are more than 300 million people who participate in self-directed investing in a universe of only 100,000 global public companies. And so there's an opportunity here for those who can capture it. And Africa is already a very attractive investment opportunity. The population is booming, innovation is happening. There are already over 438 companies in Africa generating over $1 billion a year. So from a valuation standpoint, Africa is an attractive investment opportunity for global investors. But Africa has wealth and also understands how to spot their own opportunities. And so capital will not just flow into Africa, but will flow within Africa. enable opportunities for the continent, for the people within it, which is expected to total over 4.3 billion, or 1/4 of the world population by 2050. So what does this mean for Africa? I mean, all of these forces are positioning Africa for a catalyst moment. And now whether the catalyst is good or bad will be defined by 3 core things. 1, the ability to access capital. 2, coverage for African companies. And 3, a community of local and global investors. When it comes to accessing capital, it's going to come from the next generation investor. And they're going to find you online. From investment forums to social networks to crowdsourced research platforms, there's no shortage of resources where investors can discover and discuss investment opportunities. And in today's world of 24/7 news cycles and polarization, the flavor of the day is to be negative. And it's no surprise that most companies choose to abstain from the digital conversation altogether while focusing on the hard work of developing their company in an effort to produce that next catalyst event. The problem with this strategy, however, is that when that next catalyst event does happen, after months or sometimes years of hard work, you don't have an audience familiar enough with your company story to understand that broader context. And new investors that see that news and begin their research process are deterred by all the negative ongoing conversations and therefore hold off making an investment. As a result, your catalyst event doesn't unlock the full value of your progress, but it doesn't have to be that way. What if you could connect with investors at the exact moment where they're considering to invest your money and invest their money? And in this new world of participatory investing, that is now possible. And so what we're doing on our end is we're enabling the flow of capital through SIX by connecting investors who see the future with the companies building it through live, interactive, virtual summits hosted on the internet by video, where we promote them through ads, social media, and email. It's hundreds of qualified investors in a room where they're eager to understand your future and your vision, and they're considering where to invest their money. And the magic here is, unlike a conference room that can fit 100 people or a sports stadium that can fit thousands, virtual summits in theory have no limit to the number of participants. And so as a result, your access to capital and the investors that hold it are also unlimited. When it comes to creating coverage, it's going to come from the next generation analyst. And this next generation analyst is going to look very different from the analysts that have come before, because now there are 0 barriers to entry for them to share their investment thoughts and ideas. They're going to be compensated by the crowd rather than by companies or by banks. That next generation analyst is going to effectively be a citizen journalist. And this is already happening on Twitter, on Spio.ca, on Stockhouse, and also on SIX. So on our end, we built a social network that's connected investors, analysts, and companies all in one place. And the backbone of our network is the user-generated content submitted by these next-generation analysts. The crowd will reward the creators of the content that they find valuable. And communities will be built by the next generation company. And in the world of participatory investing, in which crowds choose kings and regicide is the new normal, it's very dangerous to leave crowds unattended, especially when many of them have already gathered on forums like Stockhouse, Spio.ca, Seeking Alpha, Twitter, and other digital channels. Rather than practicing a strategy of avoidance, the next generation company will proactively engage the crowd by inviting them to participate in building their companies. SIX invites investors to submit questions, leave feedback for management, and to engage in a dialogue, conditional that they reveal their identities. And by design, we identify the detractors, the passives, the promoters, measuring a unique value metric, which we call the Investor Net Promoter Score, or INPS, with an aim of generating community support. All of these trends are accelerating in a COVID-19 world, and the need to adapt and overcome physical barriers and liquidity shortfalls demands a solution that enables self-directed, participatory, and decentralized investors to invest in the companies on the continent of the future. So, thank you.
Thank you. Thank you very much, Bianca. I think you've raised some very interesting points, and I think in some senses, the regulatory architecture of the current system, I mean, which really was put in place post the crash of 1934, the crash of 1934. If you think about it, the SEC, the Securities and Exchange Commission, the regulatory architecture, all of that was put in place after the Great Depression, effectively. So it will be very interesting to see what architecture comes in place after this. It's actually quite interesting. I don't think most people have thought about it, that the current securities regulatory architecture emerges out of the Glass-Steagall Act of the 30s, when we had a Great Depression, and there had been the whole stock market had collapsed, and the whole world had gone to hell in a handbasket. And you think of what all the banks are saying in terms of contraction of GDP, etc., that at the moment, going forward, companies raising money through digital platforms would become a necessity. It will not be a luxury anymore, because frankly, people can't go to their big investment banks as easily. Like you said, analysts are all working from their basements, and therefore a really good research analyst sitting in Timbuktu, who has a wonderful brain and can look at the balance sheet of a company or an income statement, or can look at some aspect of that company, is as competitive as an analyst from Goldman Sachs if he has the platform, because in a certain sense, people will be going online to look for these research notes, and if it's a good research note, it will stand out. So I think you are completely right, and SIX is revolutionary in the sense that the world that is coming is a world that would favor smaller groups, would favor standout analysts, standout companies, and in a certain sense would put at some peril the business of these large institutional investors. So maybe we'll turn to Millie, since at Deloitte, most of their clients, I presume, would be large institutional investors and corporates, to maybe give a different view. How do you see the big companies, consulting, research, advisory companies, audit companies like Deloitte and your peers responding to this more nimble world, where you're not going to have these big companies sort of go through the normal funnels, but would begin to be much more creative in a Schumpeterian way, looking for new ways of engagement. So, to Millie.
Hi, can everyone hear me? Okay, wonderful. Good afternoon, everyone. Thanks for joining, and thanks for having me. So my name is Millie, and as mentioned, I'm an international tax manager and lawyer here at Deloitte in Toronto. Today, I'll be exploring a couple of topics condensed in the interest of time. I'll be starting with a brief background on COVID-19's impact on the mining and energy industry at large, followed by the imperative of new and digitized supply chain models. I will then move to discuss in brief Canada's COVID relief measures, followed by cash flow, tax and structuring strategies to consider for businesses on the phone. Now, the mining sector, as we all know, is highly globalized and dependent on commodity prices. And the crisis, along with recent actions by OPEC members, has led the drop in global stock markets and a deterioration in some commodity prices due to this decreased economic activity, all of which directly affect mining operations worldwide. So we heard today the announcement of China's economic contraction as well, which no doubt will trickle through global prices. A drop in Chinese consumption of raw materials has impacted some commodity prices as well as oil and gas. Oversupply concerns continue to pressure oil prices, even as OPEC agreed on April 9th to cut production by 9.7 million barrels a day. The deal is the single largest output cut in history, and market reaction was muted and oil prices retreated on Monday morning. Goldman Sachs has described the outcome as historic yet insufficient, and our in-house chief economist tends to agree. Incidentally, copper is one commodity we have witnessed to experience a surge in price as equity markets stabilized briefly last week. Copper prices also jumped this Tuesday after a rebound in Chinese imports of the metal, suggesting the country's manufacturing sector may be emerging faster than initially thought from the COVID-19 slump. Gold futures climbed on Monday to mark a finish at their highest price in more than 7 years, finding support as investors eyed losses in the stock market and weighed expectations for further moves by central banks and fiscal policymakers to boost the global economy. So while the price rally appears to remain on track, now momentum indicators are starting to flash overbought signals as investors lie in anticipation of a global economic decline, especially with today's news of China's contraction. Projects in the exploration and development phase are also being impacted, with field activities being cut, suspended, or delayed, adversely affecting commodity supply over the longer term. National lockdowns, for example, in South Africa also ensued, originally scheduled to last until 16th of April and now extended until the end of April. So in order to properly address these uncertainties, mining companies have been implementing internal measures to ensure compliance with government restrictions, and many Canadian mining companies, rather, have announced a number of protocols such as physical distancing, work from home policies, corporate travel bans, etc. Corporate businesses and companies are now forced to carefully address personnel safety, supply chain issues, and cash flow management, the latter of which I will focus on later on in this presentation from a Canadian standpoint. So note that in order to comply with these international restrictions, federal and the provincial governments in Canada have put in place guidelines to help prevent the spread of the virus. And one of the measures that have been taken by the provinces is the implementation of a list of essential services. So businesses that ensure global continuity, supplying mining materials and products, so copper, nickel, and gold, have been labeled as essential, and BC, Ontario, Alberta, Saskatchewan, and Quebec have all indicated similarly in this regard. One crucial takeaway in wake of the crisis is the imperative for a new supply chain model. Now, supply chains have become highly sophisticated and vital to the competitiveness of many companies, but their interlinked global nature also makes them increasingly vulnerable to a range of risks, with more potential points of failure and less margin of error for absorbing disruptions. A decades-long focus on supply chain optimization to minimize costs, reduce inventories, and drive up asset utilization has removed buffers and flexibility to absorb disruptions. COVID illustrates how companies may not fully appreciate their vulnerability to global shocks. Fortunately, new supply chain tech is emerging that can improve visibility across the end-to-end supply chain and support more agility and resiliency without the traditional overhead associated with risk management techniques. The traditional view, as shown here, of a linear supply chain and optimizing for your business is now transforming into digital supply networks, or DSNs, where functional silos are broken down within an organization and you are connected to your full supply network to enable end-to-end visibility, collaboration, and optimization. Increasingly, these digital DSNs are being built and designed to anticipate disruptions and reconfigure themselves to mitigate their respective impacts. Advances in technology are making evolution to the supply chain more possible as well. So for instance, factors such as automating manual processes, a cloud-first approach, virtual collaboration, and new modes of working. So rethinking established paradigms, for instance, around physical presence. All of these are having an impact. Technologies such as IoT, or the Internet of Things, cloud computing, 5G, AI, 3D printing, and robotics, these are all crucial to enabling the DSN of the future. At the same time, a volatile business environment is making it all the more necessary. So whether it's a black swan type event like COVID, a trade war, regulatory change, or labor dispute, companies are now learning to count on the unexpected. Risk management will be an integral element of that design, as the key will be to build a resilient supply chain that not only seeks to reduce risks, but also is prepared to quickly adjust and recover. Bottom line, Business and technology leaders have an opportunity and an obligation to help lead their organizations through this crisis, and they must prioritize their efforts. If there is disruption, there will also be recovery. So how leaders act in a time of crisis can also inform long-term impact. Deloitte has a committed supply chain management group in risk advisory that advises on precisely such issues. So by all means, please reach out if you would like a contact in that group. Now, I'm going to briefly go through the various Canadian COVID-19 relief measures. There's a lot of resources out there through Deloitte or other means, and so I won't spend too much time on them, but just to give a global view. So for companies that have an upcoming tax liability or payment, be aware that deferral of income tax payments is in effect for payments that were in effect from August or up to August 31st, rather. Now they can be paid on September the 1st. There's also a 5-month interest and penalty-free period for Ontario mining businesses unable to file or remit provincial taxes. And just note that this does not apply to non-resident withholding taxes. So for the multinationals on the phone that have interest, royalties, and dividends in question, this will not apply in terms of deferral. Also for VAT or excise tax, we've also received deferrals based on your filing periods. And in terms of any CRA audits, collections, objections, and appeals at tax court, those are currently in abeyance or on hold for the time being for the most part. If you're a multinational, in terms of the tax compliance, you do have to be aware that your deadline is still June the 1st for your T2s, whether you're national or multinational, for your Canadian operations and your Canadian subsidiaries. So you have to keep all of these filings in mind as well. If your company is experiencing liquidity issues, which is primarily most businesses in our space of interest here, the Business Credit Availability Program has been enrolled with BDC and EDC in Canada to provide more than $10 billion of additional support. Now, they mostly target SMEs, but again, junior mining companies will certainly benefit from this. And I know that the Chamber has released information on how it can assist in this regard as well, to work with BDC and EDC as well. In terms of personnel and employees, so we've seen a lot of literature out there on the Canada Emergency Wage Subsidy, so CEWS. It's gone through a few iterations, but primarily, bottom line is if you're seeing at least a drop of 30% in revenue from COVID, you are eligible for an employee subsidy on remuneration based on a formula, but roughly 75% of the amount of remuneration paid. And so there have been some new releases in the last couple of days on the required revenue thresholds in order to obtain qualification for these reductions. So keep that in mind as well. Now, non-arm's length revenues also incidentally apply. So if all of an eligible employer's revenues originate from a person it does not deal with at arm's length, rather, it may still qualify for the program. And there is still some interaction with the 10% wage subsidy that had been previously announced by the government. And you have to just watch out for how you use those two in conjunction as well. Again, if you have employees working from home, in terms of home office expenses, there are some reimbursement considerations that you might want to take into account. So I also just listened in as an update. Trudeau's government also announced today that it will be putting in $1.7 billion towards cleanup of orphan wells. This will assist primarily BC, Alberta, and Saskatchewan, and the government will also set up a emission reduction fund of $750 million, of which $75 million will be allocated to cut emissions in Newfoundland. So just hot off the presses as well. I will just add that with respect to South Africa, for any listeners on the line, on April the 1st, various draft tax legislation was released. And for instance, we had the Draft Disaster Management Tax Relief Administration Bill. This allowed for the deferral of deadlines for payment of employees' tax and provisional tax, and also provides for extension of time periods for specific tax obligations, including the period of withholding tax declaration forms. So this is relevant for multinational mining companies as well. SARS had also issued a ruling on March the 26th for the export of goods by vendors and qualifying purchasers affected by COVID, which permits an extension of the deadlines under certain circumstances. So note that Deloitte's website also includes details of the VAT refunds and other dates for reference, so please feel free to email me if you'd like any such resource link. So now into the meat of the presentation in terms of cash flow. Now, companies should immediately develop a treasury plan for cash management. There should be a focus on collections, and reducing aged accounts receivable should be an immediate priority. Extending payables where possible to conserve cash will also be important. Cash flow strategies include simple measures such as distribution, dividends, returns of capital, repayment of loans, issuing new loans. Consider also the extended payment terms, discounts, deferrals, and waivers of certain type of payments as discussed in brief above. In terms of strategies going the other way, consider entities prepaying for next year's worth of inventory, services, or royalties to get cash to the right place. Deductibility and payment terms complications could arise, which need to be taken into account. So additional COGS in terms of the cost of restructuring, or an enhanced role at headquarters, or entities or people that allow for certain charges previously not made historically will have to factor in as well. Consider also purchase and sale of assets or the repurchase of inventory in the places that you need cash. All of this will be taken into account when you're providing an analysis. In terms of a new loan strategy, moving cash back to Canada from a foreign subsidiary, one way to do this is to lend money up the chain by way of an upstream loan. Now, this seemingly simple strategy, however, can have adverse effects. With a foreign US sub, for instance, repayment in the future may result in Forex gains on one side of the border or the other, regardless of whether the loan is denominated in Canadian or US dollars. There are ways to eliminate this risk, for example, routing the funds through a disregarded LLC. Consider also the impact on your existing financing structure by causing interest on existing loans to suddenly be treated as FAPI, or foreign accrual property income, which is undesirable. Also, if a loan needs to be in place for over 24 months, you may need to demonstrate sufficient attributes. So, for example, exempt surplus, or in the form of the basis in the shares of the lending affiliate. Sufficient attributes should be in place at the time the loan was made, i.e. right now, in order to claim a sheltering reserve against the upstream loan inclusion. These are examples of different strategies that, if you don't think about now, can be a headache down the road. Some other strategies for preserving cash include eliminating sources of tax leakage, so deferral of tax payments. Note the sources of relief discussed as mentioned are not all-encompassing and comprehensive. So we still have Part 13 withholding tax in Canada, US-based erosion and anti-abuse tax or BEAT provisions in place, Part 6.1 tax on taxable pref shares. All of these remain unaffected, so keep that in mind as well. On deferrals, consider also the impact of deductibility of the amounts in question and whether this is important to your organization in light of shorter or longer term financial projections. Even if deferral makes sense, you may still want to find a way to move the underlying cash. One way of killing two birds with one stone is not to think about deferral, but a more permanent solution perhaps, by allowing the payments to continue unabated, but trying to eliminate the sources of tax leakage. One example of how we can achieve this is through a coupon strip transaction. This applies to Canadian companies that owe debt to a related non-resident, non-US party. These payments are subject to at least 10% withholding tax on interest under most treaties. How it works is the non-US creditor undertakes to sell the future stream of interest payments to a related entity in the US within the group. At the time the interest is actually paid, which is when we look at withholding tax paid or credited, Canada will likely, all else being equal, be able to reduce withholding tax to zero under the Canada-US tax treaty. Meanwhile, the overall debt instrument and the principal will remain outstanding owing by Canada to the non-US creditor. For those less impacted by cross-border payments, it is important not to overlook the impact of indirect taxes and overall cash position. A special one-time election for a one-time cash injection could be available, depending on a review of the accounts payable data and what this looks like from an indirect tax perspective. When we're dealing with losses in business, loss and profit-making entities are also to be considered alongside avoiding as much as possible cash tax payments for 2019's tax year. The US has opened up an opportunity to carry losses back 2 years at a 35% tax rate compared to the current 21% tax rate, which is of interest to any multinational with a US subsidiary carrying losses in 2019 or 2020. You have to also consider looking at inventory and reserves, as current circumstances have changed risk tolerance and a desire to have profit in certain places. Many entities are in protected certain jurisdictions because they know they are aggressive from an intercompany perspective. When considering the impacts of loss carrybacks, think about triggering a short year-end perhaps, and thereby accelerating loss carrybacks for the current year and unlocking prior year tax refunds. Consider a structural simplification, which can be achieved through an amalgamation, for example. Timing is also important for triggering a tax year-end to optimize the amount of losses available for carryback. Now, this will be affected by what is driving the expected year loss. Is it a function of short-term write-down of inventory? Take steps to crystallize it into place if so. Or is it a longer-term effect of an anticipated lack of revenue? That impacts whether you want to trigger the strategy. You may also want to consider the impact of losses on retainer measures and the ability to deduct interest on cross-border related debt, or the future ability to pay tax-free intercorporate dividends. Now is the time to consider crystallizing historic earnings by way of a puck increase, and consider knockoff effects and other structurings that may be required as a result. On transfer pricing, now the current economic landscape with the volatility of commodity prices as discussed and the decrease in interbank interest rates, this will have an impact on transfer pricing documentation between cross-border non-arm's length parties, and more scrutiny perhaps of the arm's length price charge between these companies should be looked at. So consider rather expanding the selection of comparables in the economic analyses of your reports, as well as the full range and the interquartile range of comparables so as to conduct activity within those ranges. Now, transfer pricing positions are arguably still defensible, but you might want to overall assess the situation. In terms of permanent establishment risk, now Canada and other countries have implemented travel restrictions. This may have an impact if remote sales team or personnel members are in Canada, but are working on behalf of a foreign subsidiary. Or, for instance, if management decisions are being made in Canada on behalf of the foreign sub and contracts are concluded in Canada on behalf of the sub. The impact will really depend on the business model, facts, and circumstances, as well as duration of the travel restrictions. Bottom line, what happens is if you're found to be doing so, you might induce a tax liability in the jurisdiction in where personnel are now being stuck or concluding contracts or running management decisions. In terms of central management and control, many countries tax companies based on their residence. And so a review of company central management and control and helping to determine residency is what's at stake. An important aspect of determining where a company's central management and control is located is examining where the board of directors meet. So as a result, companies will often hold regular board meetings in their jurisdiction of residence and require members who aren't living there to physically travel to the meeting. So now, if a board meeting is to be conducted with directors participating via conference call, some practices should be put in place for the call to ensure that the central management is not impacted. The OECD Secretariat has released analyses of tax treaties and the impact of COVID on permanent establishment, implications of employee dislocation, as well as company resident status. Now, the CRA has not yet, to my knowledge, come out with official guidance on this topic. Based on various verbal comments made in conference, the CRA appears aware of the guidance issued by Australia and the UK and is generally aligned. But until we have something in writing, this is a risk tolerance question, depending on what your organization is prepared to accept. And finally, on flow-through share financings, very generally, a flow-through share is a common share issued by an exploration company, which then agrees to incur Canadian exploration expenses, or CEE, in an amount equal to the subscription price for the share, and to renounce the expenses in an amount not exceeding the subscription price to the investor. The investor may then deduct the expenses as if they had incurred them directly, which is a huge tax incentive. Under the look-back rule, 100% of CEE incurred in the first and second year may be deducted in the first year by the investor. Additionally, the mineral exploration 15% federal tax credit for individual investors, which is normally extended annually federally, has been recently extended to expenses incurred before 2025. Finally, the OECD, as mentioned, has released many COVID tax-related publications, as well as provided a March update that the OECD is working full steam ahead on the project addressing the tax challenges of digitization of the economy, or better known as BEPS 2.0. In the interest of time, we cannot get into that in this presentation, but I will focus briefly on an instrument already in effect, which is the multilateral convention to implement tax treaty related measures, or MLI for short, which was released by the OECD in June of 2017. The MLI targets treaty shopping across the globe. Many countries have signed it but not yet ratified it through domestic legislature, and a number have ratified and deposited the instrument in their domestic laws, and it is now in force and effect. The MLI lists 94 tax treaty countries as being potentially modified by the MLI, with 4 additional countries expressing intent to sign as of March the 11th. The MLI enters into effect in Canada for withholding taxes on January the 1st of 2020, so already in effect. And for other taxes, which is capital dispositions, it will start for tax years beginning on or after June the 1st, 2020. Which for calendar year-end taxpayers would be January the 1st, 2021. So it's important to perhaps consider restructuring if you have any capital dispositions to take care of now before this tax year is triggered. So just very quickly, this is a global tracker providing an indication of which countries have signed on. Countries in blue are those where the MLI has been ratified into domestic legislature and deposited with the OECD, so it's in full force in effect. The countries in green, the MLI has been signed but not yet ratified through domestic legislature, so it's a waiting game for those. You can see there are a number of African jurisdictions that have signed the MLI but have not yet implemented it into domestic legislature, including South Africa, Nigeria, and Gabon. And so with that, we have a number of resources at Deloitte available for your purview if you wish to educate yourself more on these topics or find out more. We have an excellent economic recovery dashboard, which provides up-to-date financial and economic indicators. We also have a number of other resources available for supply chain, cash flow management, technology, and other customer-based troubleshooting issues. And if you need to get in touch with me, by all means, please reach out. I can be reached at the email or by phone anytime. So with that, I turn it back to you guys. Thanks very much.
Thank you very much, Millie, for a fantastic presentation. And just to note, we'll also include the link on the canadaafrica.ca website, where we've got other resources there too. And just a quick ad, we'll have Minister Mary Ng with us on the 8th of May. That'll be an opportunity to look at some of the more detailed questions pertaining to this aspect of investor relations and managing the tax situation at the moment in quite a tough time. Bianca, just off the back of your initial presentation, looking at how we've seen a trend globally starting to shift, I think that takes a longer view. And Millie, you've really filled us into what we're going to look at in the next 6 to 12 months. To the chair of the Canada-Africa Chamber of Business, Sebastian Spio-Garbrah, before we head over to you for your presentation, just a quick few words, if I may, on Sebastian's background. Sebastian's been leading as chair of the board at the Canada-Africa Chamber for nearly 18 months. During that time, he's been involved with ministers and the Prime Minister on the recent visit to Africa. Sebastian's advisory are both on Wall Street, but also in the UK and here in Canada, has been around the deployment of over $30 billion of foreign direct investment across the African continent. And Sebastian is a prolific writer as well, with a host of risk analysis pieces in his role heading up Demeanor Advisors, a company he set up. Sebastian, over to you.
Oh, thank you. I really thank you very much. I really enjoyed Bianca's presentation and Millie's. And I think in many ways, this post-COVID world is actually quite good for Africa, because if you think about it, let me analyze it from a number of different perspectives. If you think about it, for the last, say, 200-300 years, right? If you're sitting in Kinshasa and you wanted to get a medical degree, okay, and you wanted to learn with the best doctors in the world, you had to go to Sorbonne or to Brussels or to Paris or to Harvard or University of Toronto or wherever you had to go to, right? And in a certain sense, the knowledge base, the technological knowledge base of the world was locked up in these big universities, in scientific journals, etc. And all these institutions had, in a certain sense, over the last decade or so, migrated a portion of their courses and a portion of their knowledge base, their books, etc., online. But in a weird sense, COVID has blown that whole dam wide open. So theoretically speaking, you see, if you start from the premise that all human beings are created equal, we are all not equal in the sense of our natural or intellectual endowments. But if you start from that premise and you say that the only difference why somebody born in South Sudan in Juba and somebody born in South Bronx and somebody born in the south side of Los Angeles have different economic outcomes is because of the educational opportunities, the healthcare opportunities, etc. And clearly the access to knowledge, okay, in a certain sense. Then you see that digitization basically presents us a revolutionary opportunity, not unlike the printing press, the Gutenberg press of the 16th century, of being able to open up a whole vista of knowledge to those who are hungry. So in a certain sense, if you are sitting in, in Cape Town and you're a young woman or young man and you are really interested in computer science and in coding and you want to be part of the digital age, and let's say you are a company like Sext and you are looking for computer programmers, right? Back in the day, in a brick and mortar world, you literally had to write a resume, send it in, go for an interview. You didn't have a visa, you didn't have a work permit, you didn't have a residency card. All these things are basically not going to be up in the air, because it basically means that Sext can sit in Toronto and hire somebody in Cape Town to write a program for them or to even manage this webinar, pay that person through PayPal or some Remit or some other payment platform, and that kid can now take classes at MIT online and become effectively as good a computer scientist as the person who is there. So I'm using a non-financial example to dramatize the point that this is what is going to happen on the social side, on the which has dramatic implications for the economy. But I think on the investor relations side, which is the main topic for today, it has the same implications. It basically means that, look, if I'm running a mine, a small mine, I'm trying to I'm an exploration firm, and I'm trying to look at some assets in Burundi. I'm just picking a country, right? Back in the day, where would you go to raise money for Burundi? Most people don't even know where Burundi is. They have never heard of this name. I can assure you that there's almost no Bay Street analyst or Wall Street analyst who the normal 10-year period has heard the word Burundi in his inbox. It has never happened before. So how do you raise money for a project in Burundi? It's almost impossible to do so. But with digitization, with the move towards platforms such as that which our friends at Sext have created, you'll have this opportunity for this person in Burundi, if he or she really has a good project and he or she can present the materials in a coherent way to attract Millie and her friend, or Gareth, or Sebastian, or whoever who is really interested. Let's say they have a project they have a good project in zinc, as an example, or they have a good project in cobalt or something that is some rare earth mineral that is interesting. All of a sudden, that investor who is sitting in the middle of Manitoba on in his cottage can be connected to that company in Burundi, and through intermediary platforms such as the one that we're using today, basically make an evaluation as to whether they should invest in this thing, in this project. And that $100,000 or even $500,000, which may not be as much an investment to maybe a multi-millionaire sitting on his farm in Manitoba, may be the difference between life and death for a company in Burundi. And then that company in Burundi, once it gets to the next stage of development, clearly, you bring in brokers and all these other things. But even assuming, let's even stretch it further, assuming that company in Burundi now wants technical analysts and structural engineers and geologists to come and look at that project, right? Or to make some basic evaluation of that project. Again, digitization makes it possible for us to go online and find somebody in Kazakhstan who is laid off by some big projects in Mongolia to actually go to Burundi and look at it. And even before he gets to Burundi, if there are some soil samples or there's some imagery or something that would help him to make a preliminary evaluation, it can be sent digitally. The images, so I'm just saying that the world, much like, if you think, I'm by training a historian, okay, an economic historian, okay, if you think of the world of the 16th century, when all these dukes and earls and kings of Europe were sitting in their castles, okay, and were drinking, Rieslings and Chablais and all kinds of interesting drinks and eating caviar, right? And they heard that there's something called democracy bubbling somewhere, and a bunch of farmers who knew nothing, who didn't go to school, didn't speak Latin, right, were asking for power and some rights to vote, all these nonsensical concepts. They sat in their castles and said, this cannot possibly be. The whole world is full of kings and queens and dukes. And yet within 200-300 years, the whole world effectively became democratic, right? Or you think of another one. If you go back and you study history and you look at how Harvard, Princeton, Yale, Cambridge, all of them used to be schools for people to go to learn to be priests. Almost all of them were seminaries. Almost all of them started out as places where people went to learn to become priests or pastors or whatever, right? And with the printing press, average ordinary people were able to access information. And all of a sudden, you basically had a whole new world that emerged. So I am basically arguing on this webinar that we are living through history. And oftentimes, when you go back and you look at those who lived at major historical epochs, it's very hard for them to absorb it because you are living it. So you can't feel it, okay? And yet, I believe that the world that is coming, by this time next year, major institutions who don't transform will disappear effectively. I read an article today that said Delta Airlines said they are going to fly less people in the month of May in terms of their bookings than in the entire. They give some. No, they flew less people. They are booked to fly less people in the month of May than they flew in the entire year, like 2018 or something. It's like an inverse thing. Like it's like zero. There's almost nothing happening. So unless you are Delta and you begin to reimagine your business, unless you are a major consulting firm, major brokers, and you begin to reimagine your business, you are going to cease to exist. Much like those who were selling fares at the Hudson Bay Company 300 years ago don't exist anymore. So my point is that I agree with everything that has been said, but I actually think that the trends are actually much more dramatic than we even realize. That once people finally realize that, you know what, the gatekeepers are no longer sacrosanct, once the gods of these gatekeepers have been brought down, it's going to change the way capital moves in the world. It's going to change the way companies look for money. Because you see, back in the day, and this is my last comment on this. Back in the day, if let's say you had to do a road show and you said, I can't go to New York, I can't go to London, I can't go to Paris, I can't go to Boston or some of the major centers of capital, no one would mind you. But tomorrow morning, if I need to raise capital for any client, and I say to my clients, we clearly cannot travel. So if we clearly cannot travel, the person who is raising money from the middle of Timbuktu and the person who is raising money from Silicon Valley are technically in disadvantage in the same way or advantage in the same way. As long as they have a good presentation and they have a good project, that person who is allocating capital at a big hedge fund or at a big private equity shop, who is also working from his basement anyway, doesn't really care that the presentation came from Garrett Bloor in Toronto or it came from John Smith in Juba, South Sudan. It doesn't really matter. In a way that just 6 weeks ago you couldn't have that kind of world. So I would just end there, but I think ultimately my view is that what is going on in the longer term would be good for Africa and for the emerging and frontier markets. I think in the short term, obviously, we pray that this situation, turns around, because if it doesn't, clearly, if for instance you take the fatality rates of COVID in Europe and you map it onto Africa, it would be a disaster that would make the Rwandan genocide look like a joke. Because frankly, in most parts of Africa, there's not much clean drinking water. They don't have, toilets in many homes. Social distancing only makes sense for the privileged, etc., etc., etc. So I do think that in many parts of Africa, the real prayer of most people is that God have mercy and let this whole thing disappear the way SARS eventually disappeared and go away. Because if it continues at the current trajectory, you think of a country like South Africa, where 20% of South Africans have HIV/AIDS, which is 7.7 million people. This is a major pre-existing condition which has dramatic implications. So assuming that you even got 10% of this 7.7 million people catch COVID, right? That is 770,000 people who could die. That is dramatic stuff. And so the long and short is that in a certain sense, Africa is least prepared for this pandemic. But in a certain sort of sense also, Africa has been here before. Several major crises have taken place in Africa over the years. And the Africans, I think, are people who feel very much that they are able to emerge from all these crises unscathed, or not unscathed, but they are survivors. So, but if we can get out of this alive, I think that the next billionaires are going to be created elsewhere, and the platforms like this that are able to actually raise money for companies would rival Amazon. I mean, because ultimately, if you think about it, the biggest companies on earth now are not manufacturing companies. They are not even social media companies per se. They are companies that allow people to transact business. And Amazon is now crossed $1 trillion. So you can see that if platforms are able to allow people to coordinate the flow of capital, those platforms will become quite big. So I'm very optimistic long term, but short term, we are very concerned. Thank you.
Thank you very much, Sebastian. And thanks to each one of you. We've got questions coming through on the Q&A platform directed at each of you. Perhaps we'll start in the order of presentations. Bianca, you spoke about essentially democratizing the ability of people not only to find deals, but also to raise capital. A question from a particular African market that you would like to highlight where you've been doing exactly this.
Yeah, so right now, where we've been focusing is in the mining sector, particularly in working with Canadian companies with projects in Africa. And there's two prongs to this, right? There's this educational process within Africa of what the opportunity is, both in terms of as an investment opportunity. And that's a bit that people often forget when you talk about marketing and raising money for a company who has operations in Africa, but perhaps has a Canadian identity. When they talk about that split between talking to Canadian audiences, and what they forget is it's not that you're just talking to Canadian audiences to raise that money. You are certainly, but you're also talking to those African audiences to raise money. And as I mentioned earlier in my presentation, Africa has its own wealth. Africa has billion-dollar companies, 438 of them. And so one of the big things is understanding that there is a story that you're telling as a company, and that story is a global story. It's going beyond the individual meeting. So when we're working with these mining companies that have projects in Africa, one of the big things that we've been mapping out is the ways in which they can tell that story, both to the folks that maybe heard of it on the ground, but how do you tell that story to that global investor? And a lot of those global investors are certainly coming out of Africa. And the other thing too is there's an understanding there, especially if you are an investor in the continent or in the country, that project's actually occurring. And like Sebastian was saying, I think he got it completely right. Ultimately, what is being enabled right now is the free flow of capital, yes, but also of opportunities and of ideas. And I think that trifecta is the powerful system that allows for that free flow of capital, and it allows for the ability to raise money for these companies in this new global investor environment where they are so democratized, decentralized, and self-directed. Sure.
Thank you very much. Millie, a question just around globalization, because you covered a whole bunch of markets. Many people say globalization is being reversed. Would you think, in fact, when it comes to digital, we're seeing the opposite? So countries' physical borders and physical movement of people may be going one direction, while this sort of digital trend is leading us further into globalization beyond what we've ever seen. Any thoughts on that question?
Well, I think there's been a lot of literature of late in the traditional macroeconomic concepts of globalization versus territorialization, and the fiscal packages that have come into play from various countries around the globe to support and to subsidize various industries and citizens has certainly changed this perspective of a globalized economy. We still need countries, it seems, to assist and help out when help is truly needed. On the other hand, one way that we have changed from a very practical standpoint is, the inability to travel, to go outside, to do these things have changed the landscape such that now a more virtualized form of work is taking precedent. And so that's also impacted the globe drastically. So it seems that there's these competing forces, depending on what you're looking at or what element you're focusing on. It's an interesting time to see how that will actually evolve. I do think that the trend in the digitization or digitalization space, rather, is going to shift towards more virtualized experiences from a work standpoint. Supply chain models will have to adapt to be able to handle disruptions and delays and strains, whether it's COVID related or otherwise. We are certainly not in a position to ascertain whether COVID-19 will be the first nor the last pandemic to face the globe. And so it's a good time to start to consider moving into that direction, as we're now faced with a global opportunity in some ways to enact changes and to try a different way of doing things.
Excellent. Thanks, Millie. Sebastian, a question around African markets. Given there are 54 African countries, as an analyst, which countries do you think are best prepared to deal with or mitigate against the economic effects of COVID-19?
Well, in my position, I'm not supposed to pick. I'm not supposed to pick and choose winners, but I'll say it's like asking the Pope, which cardinal do you prefer? You can't. I can't do that. But but truthfully, I think logically speaking, the smaller countries will do better than the bigger countries. Logically speaking, I think from a structural perspective, if you are a country like Cape Verde, Ireland, or you are Mauritius, or you are Rwanda, or you are Burundi, or you are Togo, or you are even Ghana, it's easier to just manage 1 million people, 500,000 people, 2-3 million people, figure it out. How many do we test? How do we reorganize them, right? As opposed to the big countries. The big countries in Africa, I think, will have the hardest problem because they don't have the data, they don't have the institutional capacity, and they don't have the operational competence, frankly, to be able to manage a dynamic. The problem with the pandemic is that it's dynamic. It's like every day the science changes a little bit. Every day the technology to test change. Every day the cases and modes of transmission change. So it's a dynamic organism and it's mutating, and the virus is already mutated into 3 or 4 versions of it, right? So I think that if I was a betting man, I think the smaller countries will do much better than the bigger ones. I think that for the bigger ones, those that already had pre-existing healthcare infrastructure that was quite decent, and also have data systems, like for instance, you think of in Kenya, where everybody has a national ID card, everybody has a tax ID. There's been some geospatial mapping of the country. So in that sense, you can say, look, there are so many kids in this province, there are so many adults here, there are so many old people here. You have some data to work with. I mean, one of the phenomenal data points we've gotten out of this crisis is that in China, because of this controversial policy in China, where they have something called social credits, where they monitor everyone's movement, they know what you bought, where you slept, what you did, how much alcohol you drank. They have a whole huge data farm of all this information. So they were able to figure out that, okay, you went to Wuhan and there are all these trackers on your cell phone. And I mean, it's a very data-centric process to manage a pandemic of this nature. So I think that broadly speaking is the case. But I think from an economic perspective, the countries that were already relatively resilient. So you think of countries where the debt to GDP wasn't so high, the country that had a diversified economy, countries where the level of digitization. So if, for instance, you go and pick a data set from, for instance, the ITU, the International Telecommunications Union, they have a data set that will tell you every country's internet penetration. So the level of internet penetration per country is a well-known fact out there. Okay, and I wouldn't be surprised that if I was doing this analytically, you take that data set and if you overlay it on top of the COVID cases, you could actually write an equation that would show that over time, the countries where there's higher internet penetration, there's higher online capacitation, right, would be able to manage this much better, because this particular pandemic requires regular information updates and a fight against disinformation. You see, so I think that those are some of the ways that you think about it. When Ebola, for instance, struck, we did some research at Amina back in the day where we looked at doctor-patient ratios and nurse-patient ratios in the countries where it was affected. And we basically, at the time, were able to forecast almost 3 months out that even though everyone was scared about Nigeria, because Nigeria is the largest economy there in West Africa, because the doctor and nurse patient ratios were much, much, much higher, almost 3-4 times what they were in Sierra Leone and Liberia and Ghana and other places, that Nigeria was not actually as vulnerable as those countries. So I think analysts would have to come up with different metrics. And I think for me, an easy one would be the level of internet penetration, the number of cell phones usage, average time used on the internet. That would give you a sense of the depth of knowledge possibilities that these countries have. Because everything we are talking about can't work if there's no internet. And this is also why this whole controversy of the 5G platforms is very interesting. And we overeducated people don't take it seriously, but I have gotten dozens and dozens and dozens of WhatsApp and other social media forwards around the world of people basically saying that 5G is what is causing the COVID. And a lot of people believe it. We may not necessarily believe it, but a lot of people do. So that is also very detrimental, because if you don't have secure and high capacity internet platforms, you can't possibly deal with this pandemic.
A question to either one of you: do you think listing requirements on on exchanges in Canada loosened or made easier as a way to incentivize more capital flowing through listings? Perhaps Bianca, you may have some thoughts.
Yeah, I don't know if the listing requirements.
Given many of your clients, I understand.
Yeah, I don't think the listing requirements are going to loosen. What I think is going to happen is we're going to rethink the systems already in place within publicly listed companies and how they can thrive in this environment. And one of the ways I think we're going to see that change occur is around rules around short selling. So one of the big things that we're passionate about, and I'm passionate about at SIX, is a movement that we helped found called Safe Canadian Mining, which is around the reinstatement of the tick test. And effectively here what we're looking at is we're trying to prevent predatory short selling, because what often happens is these companies will have so many shorts in that it's very, very easy to completely overwhelm a smaller company, shorting them on the uptick. And so that's a big thing I think that we're going to see addressed. And truthfully, if it was not but for COVID-19, I think that would probably be something we would have seen addressed in the spring. And fingers crossed, we see it addressed, in the fall. But I don't think it's so much with the listing. I will say that what I hope loosens a little bit is the rules around AGMs and other mandated business activities, and the ability to do that digitally. Because for a long time, there were rules put in by the companies or put in by exchanges that you have to have these meetings in person. And I was having a conversation with somebody just this week, and they are planning to do their in-person AGM right now because they're mandated to do so. And I think that absolutely needs to be rethought, and the rules around that needs to be loosened. And I think, Sebastian, in large part, we're probably going to see the movement online, like you mentioned, and it does rely on the internet. And so long as we're able to get online and discuss what's going on, I think there's no reason why these events can't move online. So I think it's less about the listing and more about the business activities and preventing that predatory short selling. And actually, yeah, I see Daniel added in the Safe Canadian Mining mantra and link there. So feel free to check it out. The big thing here is just returning back to the previous regulations that were in place in 2012 and worked quite well. And then, and then with the emergence of algo traders, they removed that rule to allow for open trading. But as a result, these small cap companies were negatively impacted and remain negatively impacted by this predatory short selling. So definitely check that out in the chat there. And yeah, but what do you think, Millie, Sebastian? I'm curious about your thoughts on whether or not you think that the exchanges are going to loosen restrictions given this new environment.
I think they would have to. I mean, they would absolutely have to. I mean, if capitalism is on a ventilator here, right? I mean, if we are not careful, we'll asphyxiate the entire capital structure. I mean, companies cannot meet, investors cannot. I mean, the whole capital structure is in a sense at risk. So they would have to loosen some of it, especially with regards to AGMs. And I think, sometimes sometimes when someone's, you have a crisis in one industry, others in other industries tend to not care. But this is a crisis that has affected every country, every industry, every economic subsector. So I think that those regulators tend to be they always lag technology. So regulators by nature are not people who go ahead of technology. They are relatively conservative people using it in a non-political sense, and they tend to wait to see how technology would evolve before they try to manage it. But I think this crisis has basically meant that they would have to now leapfrog and run with the technology. So I expect that the initiative, the excellent initiative of the Safe Canadian Mining Initiative and other such initiatives would happen. Because if not, I mean, let me give an example. PDAC happened just a few weeks before this pandemic became global. How are you going to have PDAC next year? Assuming that we still have this pandemic, right? Think of the event management business. Think of how many thousands of companies have come to PDAC every year to make presentations, to meet with investors. How many of us here have gone there to sell our own services, etc.? How are you going to do that if the pandemic doesn't abate? If there's a second wave in the fall, or there's a third wave next winter, what happens? What if we go to COVID-19, COVID-22, COVID-36? I mean, what happens? So I think that innovative capital markets are going to do so. And one risk for Canada, and maybe this is an article we all should write, one risk for Canada is that if Canada doesn't front run this crisis in terms of innovation in its capital markets, and say the London AIM does so, or Mauritius does so, or the NASDAQ, which is an already highly tech-centric platform, does so, it basically means that the capital raising process, which is around mining, which is very well centered in Canada, would move to the NASDAQ. I mean, because if I'm going to raise, some money for my company, which is a mining company, and I cannot do it in Canada because of all the restrictions, but the NASDAQ has created an amazing digital platform where I can do that. Why on earth will I come to Canada to do it? So again, this crisis has upended traditional institutions. And if I was sitting as a regulator rather than as an analyst, I would say that we should think out of the box and say, what if this lockdown continues to December? What if in mid-November there's another surge in corona cases and countries begin another wave of lockdowns? What would happen to all these major investment promotion activities. And therefore, I think that the regulators who don't adapt and front run this crisis are going to lose a lot of listings, a lot of M&A activity to regulators who do, whether there's the Germans or the French or the Americans, whoever become, or Hong Kong. I mean, whoever becomes much more digital says, look, you can register your prospectus digitally, you can do your roadshow digitally, you can get your qualified investors digitally. You don't have to show up. Why wouldn't you sign up for that one?
Thank you very much, Sebastian. I just wanted to check if either of you had any questions or comments of each other, or if anything that has been said already. We have gotten through the questions that were in the chat queue, so thank you very much for those answers.
Yeah, no, I guess my question for question. So I was reading a few articles about, was it 5 predictions for a post-COVID-19 world in terms of some of the major things we're going to see as a result of the long-lasting changes. And I think we can both agree that, you know, what we're going to see out of this is people are going to prioritize the abilities to form digital relationships, and they're going to often make decisions about where to go and what events to attend based on if they can do it so digitally, and like you were saying about the exchanges. But what other predictions do you have for this world after COVID-19? What will not be the same? Like, one of the big things that I've been thinking about, and I know Millie, you mentioned this, was around the bans around travel, and when are we going to see that lifted, and what is that world going to look like, even if we get past this first wave? So curious if you had any thoughts around that. That's what I've been thinking about for a while.
Since I last spoke I would ask Millie if she wants to go first.
No, that's okay. Can everyone hear me?
Yeah.
Excellent. Well, you know, it's certainly going to be a trying time for businesses, and it's you know, from the perspective of whether we're going to move into a direction that's eventually going to emerge in a positive direction, that remains to be seen. But I think, you know, I'm optimistic personally from an advisory standpoint. I do think that there will be slow recovery perhaps at the end of 2020, beginning of 2021. That's certainly going to be exacerbated by China's announcement today of economic contraction. So, you know, from an investor standpoint, you know, often we're told that when things are bad, it's a good time to be forward thinking instead. So instead of letting it wipe you out from the bottom, allow it to be an opportunity to build slowly back up. And I think that's just general advice that, you know, anyone would try to provide for an investor right now. From my standpoint as an attorney and an advisor, I always think of ways and strategies that you can use to maximize the situation that you're in, no matter how dire. And that's what I've been trying to put forward to my clients and my prospective clients, that there's always a silver lining, even if it's not immediately apparent. So I hope that answers the question. I mean, if I might have missed any portion of that question, by all means, let me know. I'm happy to elaborate more so, but trying to inject a little bit of positivity and hope for our viewers and listeners out there today.
No, I agree with Millie. I think you know, out of chaos comes responsibility and opportunity. I think, Bianca, in a certain sense, if you think about it, there are certain things which won't change. The family won't change. We'll all come out of COVID, you know, loving our families more than maybe we did going in, because we are stuck with them. COVID basically has made it clear to everyone who really ultimately cares about you, right? It's not your company, it's not your government, it's your family. I mean, all of them are good, but I think we would come out of this, people would be much more, I think, reflective, and people would probably work less hours. People would take more vacations. So I think we are going to have a more, obviously everyone wants to go back to work, but I think people will go back to work change. It's almost like you think of when you hear of the World War II generation, they went to the war and they came back and they were changed. So I think these major global events over time affects the gestalt of the way people think and the way people reflect on things. So I think that the travel industry to vacations will probably make money. However, I do think though that on that same score, I think people are going to be more cautious about traveling willy-nilly to every conference, because if you say to your spouse and to your family, I'm going to Ecuador for an investment conference, I'm going on a road show to Boston, I'm going to Milan to go see my client, you will have to almost justify it to your family. Why do you need to go? Is there no other way to do it? Is there no Zoom? Is there no webinar? I mean, why do you have to go? So I think in a certain sense, we are going to have fewer meetings, but more important meetings. So when you step out of your house and you sit on that plane and there's a I don't know if you've seen this. Naomi Campbell took a flight from LA to New York, and she's dressed like an astronaut. I mean, she's completely covered, on the flight. So if you have to go through that, the reason has to be really, really good. So I think in that sense, it really reinforces the points we've all made earlier, that the digital platforms for raising capital, for raising money, becomes much more critical. So you might still meet that company before you make that final investment in Burundi, but the first few interactions are definitely going to be online, over the phone, over video, etc., etc., etc. So in a certain sense, I think that will have a major impact on the way capital formation occurs. And this is arguing that it inures to the benefit of good projects owned by people who don't know anyone. So if you have a good project and nobody knows you, you didn't go to Harvard, you didn't join the fraternities, you are not a member of some private members club in London or whatever. I mean, like whatever those cohorts of, you don't belong to the Toronto Yacht Club. I mean, whatever cohorts of social groupings makes it easy for people to raise money, right? You can't go to the synagogue. You can't. I mean, there are a lot of places you can't go even meet your friends, right? So all of a sudden, if you have a good project, well prepared, and it goes around and it's on the right platform, it will probably attract money. Because again, remember, with the stock market having gone down as badly as it has, and with the bond market in total disarray, in my judgment, because all the debt that is going to be issued, somebody has to buy it, and new debt tends to drive down the value of old debt. Okay, this basically means that pension funds, asset managers, family offices all need to deploy capital, and they need to go higher up in the risk scale to be able to make a return. And therefore, if you have a good project, I think so again, I'm very much with Millie on this point, that it's actually a great opportunity for all of us, and maybe for those companies which are old companies but which innovate quickly to take advantage of this situation. But for companies who think that we are going to go back to kind of an old school situation where we all sit at a steakhouse and discuss some big investment in a mining deal, I don't think it's going to happen. Even if you want to go to that steakhouse, the other two guys are not going to come, because their spouses are going to say, no, you're not going out of the house to eat steak because you want to put $2 million in a project in Kazakhstan. You don't need to do it. And I think that is going to affect the way things happen, the way capital is raised.
Yeah, absolutely. I agree with you, Sebastian. It's both from a short and long-term perspective. You've seen with cash flow being strapped in the next foreseeable quarters, you're going to see a lot of scaling back on, what was typically expended from a travel perspective, as you say, and longer term projection for interconnectedness. I do agree it's going to switch more towards virtual experiences. It will be interesting for new players entering that space, including Sixth. Is an excellent time. It's an opportunity, so to speak, to get more involved in spearheading and leading the way towards enhancing these virtual experiences and making them sound for both investors and business people alike. So. And this goes across the board for various industries. I mean, I know it's the digital services marketplace has seen certainly a positive growth period, although also challenging, because with growth comes discomfort as well, and you have to be ready to rise to the occasion for an expanded customer base. But nevertheless, it's again still to your point, Sebastian and Bianca, it's an opportunity to see something new. And for capital-intensive industries that rely, traditionally on, traditional supply chain mechanisms and models, that's really where we're going to see the greatest challenges, and hopefully the greatest shifts for those players that are now looking to the future, wondering, hey, how are we going to survive if this ever happens again? We don't know at this point from what's been projected in terms of COVID-19. Will this strain be the last? Will there be future mutated strains that'll impact our ability to return to work? Will we ever, even if we do return to work in a physical space, will it ever be the same again? Or will we be social distancing for a while to come? I think correct me if I'm mistaken, but I know in Canada, Trudeau has made comments to that effect, saying that it's likely that physical distancing or social distancing, however you want to term it, will be in effect for a while. And so, even if we go back to our respective offices and our employees return, perhaps we will always be giving each other a nice 1 to 2 meter distance when liaising together and working in teams. And so obviously some very fundamental elements of human interaction and human behavior will be impacted as well.
Yeah, but it's interesting. Despite that, I almost feel like, to Sebastian's point, the community and the interconnectivity is going to increase, both because, as you're saying, the demand and need to connect through digital platforms will increase, but also just from the zeitgeist and the spirit of what's going on right now. This is the first time, at least in my lifetime, that I have so much in common with everyone in the world, because we are all doing the exact same thing. And I just think that basis of connection, in that we're all going through this together, is a solid basis. And the fact that it's happening now in a time where we have the technology to communicate means that the stage is very much set for this global community, this global investor community, global social community to occur. The free flow of truly all opportunities, all ideas, and capital is now, and it's been a perfect storm. This has obviously been a tragedy, but in what's coming out of it, it's been really interesting to see. And I don't think this would have happened if it occurred at any other point in history. So
I think for research advisory type firms like the one I help to run, it means due diligence will become much more critical. I mean, for law firms, for advisory firms, because once it becomes all digital, right, and you are Bill Gates, I mean, I'm taking an extreme example, you're sitting out there and they send you 10 different proposals to fund, or you are some billionaire, family office guy, woman. How do you decide which one to fund? Because you can't send people physically there to go look at the assets and to tell you the asset in Burundi is there, right? So you would literally have to work much more with due diligence firms who would do that work, who have to have had pre-existing or new relationships with people on the ground. So since you can't travel to Burundi to go check on this prospective mine, and you go to Millie at Deloitte, or you come to me and you say, look, can you do some due diligence on this? Millie has to have a law firm or some consulting firm of Deloitte branch in Burundi that would go do the work, right? So you would have also a very interesting mushrooming of lots of due diligence firms, consulting firms, advisory firms, who are all basically trying to ferret out of the projects that are being funneled, which ones are real. And platforms like Sext would also have to retain lawyers almost constantly, because you don't want to also then promote a project which is a scam. So there'll be lots of scams out there. And so even if the regulators were to relax the rules around raising money through e-commerce platforms, you probably will have a lot of scams where you would have to figure out which scams are not scams, and so there's a lot of KYC that would have to occur, and due diligence. So it will be very interesting. Well, definitely.
Well, it's setting the stage for equity crowdfunding, right? And the crowdfunding model has been around for a long time in consumer products, and you can go on Indiegogo and Kickstart and support any number of things, and you'll see it historically has been a bit of a gamble whether or not you'll get your product at the end, because oftentimes you're funding ideas. And as we move into the world of equity crowdfunding, where companies can raise money from larger pools of investors in increasingly smaller increments, the KYC requirements and the abilities to create assurances that what you're supporting is real, that there is an opportunity there and it can be explored, will be increasingly important. And I think that a lot of that's going to be bolstered by digital efforts. And I see that, Jacques was saying, with less traveling, you need to have people on the ground in Africa, and companies will need to hire locally and build capacity digitally. That's exactly it. So if you are in a position where you are raising money for a project based in Africa through something like equity crowdfunding online, the ability to speak to your team and have them show on the ground, here's what's going on, here's the here's the open pit mine, here's our recent drill core, here's what's going on. That is absolutely priceless. And not to say that just seeing is believing, but it's the beginning foundational steps to creating a system that is reliable and functional and allows us to raise money from your retail investor online through an equity crowdfunding model.
Excellent. Well, thank you very much. And on that final point, Bianca, we have come to the end of time. But thank you to each one of you for being a part of this, and to everyone who's been involved, both on the chat and in the Q&A. We look forward to being with you next week, Thursday, where we will be looking at 10 a.m. at economic freedom and some of the prospects for doing business across African markets in light of the current COVID-19 situation. Thank you very much, and have a wonderful afternoon.
Thank you, everyone.
Thank you.
See ya.
Bye.